go ahead and debrief this little case study exercise. Today's Wednesday, February 8th, 2 p.m. section. I am recording our debrief to post. So the key to why I wanted you to do this kind of key value driver case study is that it really highlights at a high level the things that happen to real world companies as we apply this theory. And if you kind of understand what's happening in terms of the concepts of the case, then you have a really good understanding of why things happen with real world companies. Okay? So we went through a series of scenarios. I kind of want to talk about the impacts of the scenarios. So the first thing you did, and I'm kind of doing this from memory, but just directionally, was we had you change the expected profit of each of the companies. So when the profit increased, what happened to the value and what happened to the multiples? It's the first thing you guys are basically answering. So more profit, everything else the same. What happened to the value? What happened to the multiples? You guys put the numbers in the sim, you wrote it up. Values go up, down, stay the same? Yeah?
Value increase, multiples stay the same.
Okay, why? Why do you think the multiples didn't change? You're making more money. Why aren't the multiples changing?
They don't depend on the profit.
Well, actually, the multiples don't depend on the profit. Yeah, the multiples don't depend on the profit is another way of saying it. So here's the point. I'll keep it simple. In finance, you learn about a principle known as sizing. Okay? And the idea is if you generate more absolute amount of cash, you will be more valuable, bigger. Okay? But that doesn't make you better. Right? I don't pay more for the extra cash, but I basically get more cash. So that's just one way to create value. Just go make absolute more amounts of cash, right? But if I want to actually get people to pay a higher multiple for my earnings and my cash, it's something else. What makes me better? And that's where the key value drivers come in. So long term, there's three of them. That's what's on the formula. One is your growth and the other is spread. So it's growth, return on investment, ROIC, and risk, cost of capital. Those are the three drivers that affect better, the quality of the earnings over time. Okay, so that was the next scenario you did. You said, okay, well, instead of like one time making more profit, what happens if company A, for example, goes into new markets and can long-term start growing more sustainably? So I'm a US company, I go to Europe, go to Asia, right? So I get more sales. Don't change my business model, but I can still make more money because I'm growing at a faster rate. So instead of growing at 5% a year, I grow at 6% a year. What happens to the value in company A when their profits go from 100, 105, 110 to 100, 106, 112 to 100, 107, 114? Profits are going up every year. What happens to the value? What happens to the multiples? They're not changing, are they? Why not? Yeah.
Probably because they have a lower expected ROIC in the industry.
Well, if their ROIC is 10%, why isn't the value going up? It's not just that it's lower. It's one other key point here. Yeah.
It's because the ROIC is equal to the cost of capital, so they're not creating any value.
And if your ROIC equals the cost of capital, that's a proxy for saying you have a zero NPV business, right? And if you grow a bunch of zero NPV projects, you know what you get? Zero NPV, right? So when the cost of capital or hurdle rate equals the return you're making, the IRR, and remember ROIC is just a one period IRR, when it equals the rate of return you're making, you're not creating any value, you're just basically breaking even on a value creation standpoint. So that's the point. I like to call business A the treadmill, okay? And the idea is you run really fast on a treadmill, you eventually get tired, but you don't go anywhere. And you might even fall off, all right? And this is why we start talking about good growth and bad growth. And a lot of companies end up in the treadmill and they get very frustrated because they're like, look, I'm growing my sales and profits. Why is my stock price not following? What's wrong here? What's wrong with the market? Why can't they figure this out? And it happens to companies a lot. So I'll give you an example of a company I work with that it's happened to. I tried to explain to them what's been going on with your stock price. Why isn't it going up? And the company's called Merck. They're a great pharmaceutical firm, one of the most valuable in the world. They do amazing things. They truly cure cancer. You say, like, oh, do you just cure cancer? They really do, okay? But here's the thing. When you look at their share price, it's been really flat. And so what I'm going to do is I want to show you why. So let's go back and look at a little historical data. And so in Bloomberg, I'm going to pull up Merck's history, FA, and I'm going to go to custom, keep it simple, and I'm going to do 10 years, 10 periods of historical data. And on my custom template here, I'm going to put in two numbers. Return on invested capital, year by year for the last decade, and WACC, year by year for the last decade. Now, one thing about Merck is it doesn't really grow. Their growth's like 2-3% a year. So growth has not been a big factor in the key value drivers. So their big factors are the spread, right? So when we look at their spread, and I'll go back beginning of the 10-year period, 2013, 2014, I want you to visualize what you think the formula should say should happen to their share price. So the idea is, if I have a treadmill, if I have basically a break-even spread, I earn my cost of capital, my share price really shouldn't change. If I have a positive spread, if I'm earning more than my hurdle rate, my share price should be going up. If I have a negative spread, if I'm not earning my cost of capital, my share price should be going down. So with that in mind, tell me, if we had to draw a line, what that share price line would look like over time. What would it look like between 2013 and 2017? Would the line be going up, stay about flat, or be going down? What do you think? What should happen to their share price? (2013, 2014) share price going up, flat, down? Probably flat to down, right? What about 15? Back up a little bit. 16, back down a little bit, maybe. So the point is, between 13 and 17, it's probably flat, bouncy, but probably as much down as it is up. Okay. What starts happening in 2018, 19, 20, and 21? Sorry, slippery keyboard finger here. FA, custom. What happens between 17 and 21 to their share price? Kind of up in 19, maybe down a little in 20, but what about 21? Should be kind of spiking up. In fact, in 2022, they're about to release their earnings. Based on the earnings estimates, their ROIC should be in the low 20s. Okay, so continued improvement in ROIC and probably continued up in the share price. So that's what the theory would say. That's your key value driver formula. So here's my point. Graph price. Switch the time period to 2011 to this morning. That's a lot of the line we just described. Matter of fact, if I add the concept of ROIC to this graph over time, the historical ROIC that's just plotted out, that's that blue line, you'll see it's not one-to-one correlation, but fairly good correlation between what we're talking about. Like when the ROIC is flat or goes down, and not really earning lots of spread, the share price isn't doing much. And the later years when their ROIC started to improve, so did their share price. And I'm saying this shouldn't be a mystery. These are the principles that we understand, and that's why I'm saying you understand these scenarios, you can start to understand what happens to companies over time. And so the first scenario is growth at no spread. We call that the treadmill. And the second scenario that you did on here was what happens when company B starts to grow. What happens to their value and spread and value and multiple when they grow? Both going up, right? Why? Yeah, I mean that 10% spread positive, which if I can borrow 10, make 20, I want to do that all day long. And the more I do it, the more valuable I become. And so that's the point. We got to differentiate between good growth and bad growth. Good growth is company B's growth. Bad growth is company A's growth. And that was the challenge with Merck, is Merck's like, look, and these numbers look really big. Like if we look at Merck back here in Bloomberg, and I look at their historical profits on about $40 billion in revenue, and you can see in the last few years it's been pretty straight, they're making $10 billion a year on average in profit, rounding off. That's a 25% margin after tax. They're like one of the most valuable, profitable companies in the world. And that's the point. If I'm making $10 billion a year of profit on $40 billion of sales and my stock price isn't going anywhere, I think there's something wrong, right? But what the market was saying is, yes, you're making $10 billion of profit, but you're reinvesting almost all of that, right? And you're reinvesting it to build new products and service and do R&D, whatever. But when you look at the return on the investment, it's not 25%. It's a lot lower, single digits. And so because they were reinvesting so much, the returns weren't there. They didn't see the growth from all that reinvestment. They're like, this is not really valuable reinvestment yet, right? It's starting to pay off now. Market's changing its view, but that's the point. When Merck starts looking more like Company B, their value goes up. When they looked a lot like Company A, their value did not. Okay? So as I said, it's really clear to see these value drivers in action. Okay? Next scenario that we had you write up and do in your case, and again, you're kind of resetting these along the way, is what happens when you're Company B and you mature. You maintain high rates of return, but your growth rate starts to slow. So instead of growing at 8% a year, you grow at 6% a year, or even 3% a year. Right. What happens to your value? What happens to your multiple? They're both going down, right? Why? High return, but slowing growth. This is the expectation cornerstone at work. Think about it. You make 20 cents. 20% ROE is 20 cents of cash per year, profit per dollar of investment. You grow that 20 cents at an 8% CAGR. You realize you were too optimistic. Your 20 cents is only going to grow at a 3% CAGR. It's not going to grow at 8% CAGR. So if I start with 20 cents that grows at 8% a year, and I switch that to 20% that grows at 3% a year, that's not worth as much. Value comes down. Multiples compress. This is very common as companies get bigger. In fact, another reason why it's common is because it's called law of large number effect. It's hard to grow 10% when you're $1 billion. It's harder to grow 10% a year when you're $100 billion. So as the numbers get bigger, those percentages get harder and harder to do. And what I'm telling you is a large, big company is probably going to have lower multiples than a small company. And it doesn't mean they're better or worse. It just means they're different. And that's part of what the key value driver formula explains. Matter of fact, I'll show you another way it plays out in the real world today. All right? You guys are working on Google. It's one of your assignments. So one of the screens that we use a lot is called EEO. So go back to Google. I'll look at EEO. And the EEO screen, by default, top of the screen are the numbers. Near the bottom of the screen, it's going to have, I don't know why they're not showing yet here. The bottom of the screen, it's going to show the multiples. Put them back on here. And these are the forward multiples based on the forward earnings estimates. So for example, 2023 PE is 2023 forward estimates for net income divided by the current share price. 24 EPS divided by current share price, 25 net income EPS divided by current share price. But here's the point. Notice how the PE for 2023 is 19, for 2024 is 16, for 2025 is 14. It's going down, right? One of the reasons is if you look at Google, whose revenue is expected to grow despite their challenge today, if I switch these to percentages, Google's growth rate is expected to go from 12%, 12.6% to about 8.5%. The growth rate's starting to slow. As the growth rate slows, the multiples compress. By the way, this is where people in the real world make real serious mistakes. Because one of the things you're trained to do is you say, okay, what's the share price? Earnings per share times price to earnings multiple. Their price to earnings multiple right now, what was it? Right now it's 19. So you're going to grow $2 of earnings per share over the next 2 years. $2 times a PE of 19, their share price should go up $38. But what I'm telling you is their PE in 2 years is not going to be 19, it's going to be 14. So $2 of EPS in 2 years is $28 a share price. It's not $38 a share price. And a naive person would actually overvalue Google because they're assuming that the PEs are static, and they're really not. They're going to be dynamic. And what I'm telling you is as Google growth slows, the multiple will come down. And again, it doesn't mean that Google's a bad company. It just means they're different because the math is changing. And when you're bigger and you don't grow as fast, you don't trade at a higher multiple. That's why it's also unfair when we get to the final section of this class to take Google and put them next to a startup. Startups, by definition, are going to have high multiples because they got huge growth in front of them. But when you're not a startup anymore, you don't have that growth rate. Your multiples are going to be lower. So if you compare Google's multiple to that of a startup, Google's going to have a lower multiple. It's because they're not a startup. It's not that they're a bad company. It's not that the startup's a good company. It's just different. Last scenario that was on here that I wanted you to understand is what happens when you have a negative spread. When you switch company A's spread to negative, and then you increased and cranked up the growth. Notice how the value goes down, the multiple compresses. Growth at a negative spread. What is growth at a negative spread? It's a low multiple. Okay? Matter of fact, the faster I grow my negative spread, the worse it gets. Because I'm basically just throwing money away. So what's the solution there? Yeah.
What about like DoorDash or like Uber? I guess like
So basically they have growth at no spread for a long time, but they have a big multiple. So at some point there has to be a belief that that's going to flip. Because if it doesn't flip, get out. And that's what I was hinting at a couple weeks ago in class, first week of class. Because the problem with DoorDash, Uber, Lyft, etc., is that they're all doing these deliveries, and none of them are making money on home delivery. I mean, if you buy a Chick-fil-A sandwich meal for like $10 to deliver to your house, they're going to pay the driver more than $1 or $2 to actually deliver it to your house. So they're going to lose money on that, right? And right now they're trying to quote unquote make it up with volume. And that's what I'm saying. When you have a negative spread, you make up with volume. You just crank out a lot of value destruction. So the only way I'm going to pay a lot of money is if I believe that that's going to flip. So right now, price is expectation. There's a belief that it will flip. But I'm telling you, if that belief erodes and we realize that they'll never actually make money, get out of those companies. Because they're going to fall really far, really fast. Okay? But that's the whole point. So what do you do when you're in this situation? Well, I want to slow down the negative spread. 3%, 0%, negative 3%. Think about, we've been talking about Bed Bath & Beyond, okay? Here's what happened after we read that Bed Bath & Beyond article, if you didn't pay attention. The day we finished reading it, that night, they got $1 million of what turned out to be contingent financing, okay? Remember, they had $150 million of cash, negative $1 billion of expected free cash flow. They're not gonna make it, bad choices. Somebody gave them $1 billion. But then when you looked at the terms of the $1 billion, the terms of the $1 billion are we're going to give you $225 million now. The other $800 million is contingent on improved performance. And if you don't improve your performance, we're not giving you that other $800 million. So here's the point. They can't have a big negative ROIC and big negative free cash flow because otherwise they're going to burn through that $1 billion and then they're going to be left with nothing and they're going to do the same thing. And so the market's like, look, we'll give you the money, but you better turn this thing around faster and more aggressively. So they got to cut that burn rate and they got to cut the ROIC. And given the choices that they've made, what the analysts are basically saying is they bought some time, but the bankruptcy risk is not going away because I don't know if they can turn the ship around. Like they've already hit the iceberg, right? And the ship is sinking. So right now they're just bailing water and they're going to have to do some very dramatic things, but those are going to be very painful things. And so the question is, will they work, right? Given their track record, I'm not sure that they will. But that's my point of view. But regardless, they got a little bit of a lifeline, but it's a contingent lifeline. But here's the point. How do you get from a negative $1 billion of cash flow in the short term when nobody's coming to your store? You cut costs. So the one thing you're going to see is a lot of store closings, a lot of inventory liquidations, and a lot of painful layoffs. That's what's going to be on the horizon. Okay? Anyways, final scenario I had you look at. What happens when you reset this and the cost of capital goes down? Same spread, cost of capital goes lower. Well, notice the value of the multiples crank up. Watch what happens the other direction. When the cost of capital jumps from 8 to 12%, those multiples shrink really fast. This is what's been happening the last 6 months in the U.S. So as the interest rates have been rising dramatically, right? Yield on the 10-year went from 1.5 points to 3.6%. Federal Reserve's been cranking up short-term interest rates. These hurdle rates are going up. All things being equal, same cash flows, higher hurdle rates, lower values. So it should not be a surprise that the U.S. stock market's been under pressure. It should not be a surprise that you guys are having trouble in your Bloomberg trading challenge right now making money as interest rates continue to rise. And even yesterday, the market freaked out because used car prices went up unexpectedly. Right, with all the high raising interest rates, people are like, oh, people are going to buy less cars. No, used car prices unexpectedly went up, just as U.S. jobs went up. Why did that turn out to be something that scared the market as opposed to being a good thing? What's the market worried about? If you read any article about this, what's the market worried about? Why are they worried that used car prices are an issue? And why are stocks down because of that? Yes?
People are not buying new cars.
That wasn't what the market's concerned about. You would think it is, but that's not what they were worried about. Anybody read any of these articles? So I say pay attention to the real world. Learn some interesting things. The big issue that's in the world today is that basically they're worried that the Fed, which they thought was going to slow its raising of interest rates, is going to keep cranking them ever higher because they have to cool down the economy. So they were actually thinking the economy's starting to cool, inflation's coming down, we'll go back to terms of normalcy, and when they start to see spikes, that's just another reason for the Fed to raise interest rates again. So now they're more worried about higher interest rates, higher hurdle rates, more cost of capital, lower stock values. That's the trade that was happening in the market today. All right, so again, make sure you write up your assignment. Doesn't have to be 500 words, but does have to be individual. Can't turn somebody else's. Turn it in by, at this point, you got 20 minutes to do it if you want the extra credit. Okay. Final thing I want to mention is really quickly, 1 week from Monday is your group project presentation. The company that I've assigned is a company called Parker Hannifin. Okay. They're based in Cleveland, Ohio, but they're a global company, right? And basically Parker Hannifin, lots of different businesses, but they basically make industrial manufacturing equipment. They make flow systems. They make valves and fasteners. Some of their clients are airlines and other industries, a lot of different businesses. But the point is, that's the company that you're going to do the EIC on. Okay? So when you do Parker Hannifin, PHUS Equity, a couple things. First, and I put this into the assignment, RV, I told you that I want you to use best fit algorithm, and because they're a global company, even though they're based in Cleveland, I want you to use region global developed. Okay? And here where it says whole firm, if you click on this, there's 3 businesses: flow control, aircraft and parts manufacturing, diversified industrials. So 3 RV markets beta screenshots, 3 RV spreads, 3 5 forces today, 3 5 forces in 5 years. All of that in 10 minutes, all of the screenshots in your presentation. What I'm telling you is when you're presenting all this in a week and a half, practice. If you come in here without practicing and try and riff this thing through and get through all that data in 10 minutes, you're going to run out of time. And if you run out of time, I'm going to stop grading, whatever, regardless of what's in the PowerPoint. So you have to get this done in 10 minutes. So my 2 recommendations beyond get the data is, number 1, practice. And number 2, if you have to come in with note cards or sheets to help you, that's fine, right? To get through all of the information, right? Because you got to make sure you cover the data, right? But you can't just read a bunch of numbers. You got to tell me what's going on. So that's related to my next comment. So as we did last week, as we're doing this week, we talked about Google that you're working on now. You can't just regurgitate numbers. You got to talk about what's going on. That's why I mentioned at the beginning of the class what happened with BARD. Okay, real-time information is coming up that will affect, for example, what's happened to the AI growth of this business. Yes?
What's this worth?
10 points in your semester grade. You got, usually most teams in here are 7 or 8 people. You have to work on it as a team. Even if you're not presenting, doesn't matter. You have to help create that presentation. Choose who's presenting for the grade on behalf of your team. Everyone will be here. If you're not going to be here, it's a mandatory attendance day. In order to get out, you need my permission, and you're going to have to write an incremental 1,000-word paper. Otherwise, you're losing 5% of your grade. And I'm giving you one other thing in advance. The teams in here are going to be nervous. This is a big part of their grade. There's a lot they got to cover, and sometimes I can seem a little intimidating, and they're presenting to me for a grade. So in order to make sure that we pay attention to them, for that 90-minute class, no phones, no computers, no texting, no clacking on keyboards. You will be respectful and you will listen. If you're incapable of doing that, don't come to class. Because if you aren't respectful and I hear the same clacking on the keyboard that I hear right now, I will stop the presentation and I will throw her out of the room. And I will take 5% away from her semester grade, and she will not like it. That is not allowed when teams are presenting. And that's not just when you're presenting. That's fair to all of the teams. We will be respectful to the teams that are presenting. You want to type and do other stuff when I'm up here, that's your business. But when teams are presenting, it's their time, and we will respect their time, and you will respect their time. So that is a hard rule this semester. And I'm just letting you know, don't try and push me on that one. So I'm letting you know in advance. But other than that, presentations are a week from Monday. The other point I just want to mention is next week, on Saturday, I go to Singapore for a week. Long planned trip to work for a company called Parker Hannifin. So on Tuesday, I will be in a room all day with their chief financial officer, their chief strategy officer, and the senior leaders from all the business units around the world. So at the result of that meeting, and I'm under NDA, I'm gonna know a lot about Parker Hannifin, okay? And I already kind of do. So when I come back, I'll be able to share some of this after you make your presentations. But I'm also telling you, if you got 7 or 8 people and all this time to work on this, don't just come in here and read a few numbers. Tell me what's really going on with their business with the 5 forces, the competitive advantage, and others, because you are also talking to an informed user, right? And so that's the point. Like, that's the other key to these presentations, right? You're already starting to do this with Google. We kind of went over in the video some of the things we talked about with the last company. So make sure that you actually do your homework. So next week, we will not have live lectures because Singapore is 13 hours ahead. And I thought about a webinar, but that's 3 a.m. for me, for your class. I'm not staying up that late. So there will be no live webinars. So, but here's the point. This room should be utilized. So use the time to work on your team projects. Come here anyways with your team. Use the Bloomberg terminals. You're gonna need to get the data. Second, Bloomberg certification is due a week from Friday. Use that time to continue working on and finishing up your Bloomberg certification. There's another homework due that Monday. It will require Bloomberg. Use the terminals and time to get the data. All right, so even though we're not having a lecture, there's plenty to do next week, and I fully expect you to be able to use the lab, okay, to do it. And so I'm actually giving you the time to do that as well. I'll see you guys a week from Monday. Good luck at your presentations. Remember, TAs also have office hours later this week and next week if you want to take advantage of that as well. Hold on one second.